Sam Dedio, one stock you like at Patrumin Investors is Power Integrations. It's been a wild ride for this integrated circuit board maker this year. It's gone from 58 to 38, now it's around 51. So what's in store for the stock in 2016?
Sure, Greg. Power Integrations is going through a product change. So every 2 to 3 years, they introduce a new product lineup where they introduce products at higher average selling prices, get higher margins. They're also going through a inventory correction in their end markets, communications, computers. But their biggest product set is really power management chips for chargers that are used for cell phones. As you know, it's a big business, and there's a technological change in the coming year. It's going to gain the dominant part of the market share, which is rapid charge. So basically, your cell phones will now be charged in less than an hour instead of 2 to 3 hours if they're fully dead. So that's a big change in the end market, and it's great for them because it's a product cycle for them, and they get to charge higher ASPs. We'll see the inventories rebalance again, so that's great for revenues, earnings growth, and also margins. So they get operating leverage on the business as well.
All right, well, you're also bullish on Ryder Systems. Stock's down over 20% so far this year. A lot of worries about global trade right now. So why do you want to be in a logistics and a freight management company with this going on?
That's a good question. This is, to me, metaphorical to what's going on with the Dow transports. So the Dow transports are down about 11% year to date. Typically, they lead the stock market either way, up or down. They've been down since the early part of the year. So they basically signaled there's going to be a correction in the stock market. Ryder's a small cap transportation company. They do fleet management that's outsourced by larger companies like Pepsi. So it's really a good way to play economic recovery if the global trade improves. We're betting it will because the economy is cyclical. So therefore, we expect this stock to lead the rest of the market out into a recovery later in the year and into 2016. A lot of operating leverage pent up. They're also introducing some logistical software management, third-party management for companies that also adds to margins.
And you're positive on air products and chemicals. This one's only down around 3 or 4% this year. Everyone's watching the stock because Airgas recently got taken out by Air Liquide, the French company, for over $10 billion. So what does that mean for air products and chemicals?
Well, two things. That group of companies, Airgas, Air Products, and Praxair, I've written on these before. I call them the investment oligopoly in industrial gases. And what I mean by that is, you said it, it's only down 2 to 3%. And before Airgas was taken out, it wasn't down a lot. So the point is they really don't correct often because it's an investment oligopoly. Prices are relatively stable. Margins are stable. There's a new CEO in there in the last year. They've laid off about 5% of the workforce. So margins are going up. They're also going to spin off to shareholders their technology materials division, which is about over 20% of revenues. So that's going to be spun off to investors as a tax-free spin to shareholders. So what that will do will actually make margins go up because when they consolidate the income statement, that business actually had lower margins than the rest of the other main businesses. So they're going to do a little financial engineering. They're going to increase their dividend as they have been for many years. And the total return to shareholders based on cash flow will continue to go up. So it's an area now where scarcity value is the second point. There's only 2 companies now in the U.S. you could really play for to invest in to get a play on the packaged gas or the industrial gas complex.
All right, and then finally, you are positive on Supermicro. This stock's lost about 1/3 of its value. How is this going to company be able to compete with IBM and HP in the server business? It's a tough space.
Great question. On the low end PC-based servers, which is where they compete, they use Intel and AMD processors, pretty much 95, 96% Intel processors, a little bit on the AMD side, but they really don't compete with IBM there. IBM's at a higher level. In fact, IBM is their largest customer right now because IBM is desperately trying to catch up in the cloud computing space with the likes of Amazon and others that have really found a niche doing cloud computing and the outsourcing of the computing function, including the storage management. So what's happening with Supermicro is their products have been validated over the last 5, 10 years at bigger and bigger installations. So what that means is the average ticket's going up, the average server content's going up, and now they're layering on software to manage these massive networks that are being deployed based on their blade servers. So what happens now is the average selling price goes up, the margins go up because of the software management element to it, and there's earnings leverage on the fixed costs that are in place, and the profits will go up faster than the sales. The stock has been hit because of an accounting issue. That's one of the main reasons why the stock has fallen so much. We think it's a one-time event. It was immaterial to the amount of sales that was had to be recorded, and therefore we think that once this is passed, the shorts will have to cover, and fourth quarter is usually a strong quarter.
All right, well, thanks a lot, Sam.
Thanks, Greg.
And thank you for watching The Street.